24 minutes to 8 with Brian on Pacific Breakfast. I'm joined in the studio this morning by Andrew Lovell and Martin Talbot from Home Ownership Pathway for week 5 of our Home Ownership Pathway series, Bootcamp, giving you, our listeners and, of course, viewers on Facebook, steps to help you get into your first home. Over the last 4 weeks, we've covered managing your finances, KiwiSaver, credit, and looking for and submitting offers on properties. And this morning we look at protecting the pathway and the mortgages. On that note, a very warm welcome to the show this morning, gentlemen. How are we doing? Very well. Very good. Yes. And I suppose for yourself in particular this morning, Andrew, your smile's a bit brighter. Yeah. Yeah. Okay then. I was going to take my flag off the car. Yeah. Oh my gosh. Okay then, gentlemen. Well, so this morning we are looking once again at the protecting the pathway and mortgages. What's that all about? What does it mean?
Yeah. So when you engage with Home Ownership Pathway, and we set up the plan or the pathway to get it into home ownership, and that might take 2 or 3 years to get there. Protecting the pathway means we look at things or products like insurances. So there's products out there that are going to help protect that journey for our people, for our families to get into home ownership. And what we're talking about there is things like life insurance, income protection, and health insurance. So those are products that we will use to help families protect that pathway. So, for example, if your goal that was set is to come off, let's say, 100 or 200k deposit, and let's say you're the breadwinner in the family, or we've got a breadwinner or someone who's on a really good stable income, etc. What we're doing is we're looking at making sure that they've got adequate insurances in place in regards to life insurance and also income protection to protect what ultimately is the pathway or the plan, so that if anything happens to them, the plan will still continue, especially for the family and the remaining partner if anything does happen. Mm. So that's what we talk about in regards to protecting the pathway.
Okay. And insurance, of course, as well, that we're talking about not only house insurance but life insurance as well. Why, Martin or Andrew?
Yeah. Well, life insurance obviously is important because life insurance and income protection, these insurances are important because obviously we want to get to that stage of buying a home. And when we actually purchase a home, the banks want to see that we've got adequate insurance to pay, if anything happens, obviously pay back that mortgage or pay back that debt that we're going to borrow. So instead of, normally before you get a large mortgage, you're out there and you've probably got about a 20 to 30k debt, and someone can come and probably look for assets or something, or probably your income to pay back that loan if you default. When it comes to a mortgage, obviously you're looking at 4 to 5 or a larger amount, $500,000. So the banks, if anything happens to you, they want to make sure that you got adequate cover, so that if you pass away or if anything happens to you, the mortgage would still be able to be paid back.
And that's including like a mortgage protection insurance. That all comes under that as well.
Yeah. So that's all part of the when you get to that mortgage stage. That's important and a key component when it comes to buying a home.
Okay. And talking about buying a home, so up until this point we've gone, and last week we were talking about with Bob Lemalu from Harcourt's, got to get that right, about finding the right home and then making offers. And now we're getting into the real nitty gritty, and Martin, I want to bring you in on this part. Sure. Of course, your expertise and finding the best rates or communicating with a lender. Always preferably going for first tier, of course. Oh, yes, okay. Yeah. But so where to? We've got our insurances and that's it, and now we want to actually structure or formulate that or get approval. How do we go about that?
Yeah. So first of all, get all the information together, sit down with all our clients, have a look at what they've actually got, and see how much they can actually borrow. How much deposit have they got? The banks like to see 20% deposit. Of course, it's quite a chunk of money. If you're looking at $500,000, there's 100k deposit. Yeah, exactly. So we can potentially get away with 10% deposit, depending on which way we go and what the bank's appetite is for that, and whether we use some of the home site grants and all that sort of stuff. Putting that all together then, and as you say, trying to get out to the main banks. We've got the 4 Aussie-owned ones, of course, Westpac, ANZ, ASB, and BNZ. We've also got a few smaller Kiwi banks, Co-op, TSB, and SBS, and then presenting it to them and seeing where we can get to and trying to get the best offers from one or multiple banks for our clients.
Home Start Grant, what's that?
Those are some grants that the government can provide to help people that need some extra assistance. So if you've been in KiwiSaver for at least 3 years, there's a potential to get some additional funds from the government. And if you fall into some other categories, like you're not earning 130K a year as a couple, or if the house you're buying is under 600 or 650, depending on whether it's new or existing, there might still be some other assistance you can get from the government.
Is there any, and gentlemen, I'd like both of you, is there any instance where someone pretty much has no deposit but can still potentially look at getting into a home? In your experience, of course.
There has to be some form of deposit, whether they've got it themselves. There's different ways of getting your deposit. So there might be family members that can gift it. They might have some equity that they can draw on from their property. So there are potentially some ways where we can get a deposit together, even if they haven't been able to save it all themselves.
Okay, then. In terms of the sort of documentation or the main things that lenders want to see from potential lenders, either documentation or just in general.
Well, I put together the whole application form, and it's one application form which fits across all the banks, so it makes it nice and easy. That means people don't have to fill out 10 different application forms for 10 different banks. What they want to see, bank statements, annual credit card statements, or any other documentation to see what people have been doing. Certainly if you go to another bank, they want to see a bit of history and see how well your account conduct is. And other than that, really it's just a bit of backup documentation to support the application we're putting together, because a lot of it is your existing assets and all that sort of stuff that you don't have any paperwork for.
So very important. I mean, Andrew, like over the last 5 weeks, how it's sort of like that sort of natural progression to where we want to be, find ourselves in our home, but the importance of making sure a strong foundation is laid.
Yeah, definitely. So what we're trying to do with Home Ownership Pathways is work with families closely to make sure that, by the time we get to this application stage with the banks and we're out there shopping for a mortgage, that we've got that strong account management history shown in our accounts, which means we've driven down the debt, so we've got low debt, and B, we've got good account management conduct, which means that we're not going in the red, we're not going back to getting more loans, we're staying well away from getting any kind of anything going in the red or getting more loans and that kind of stuff. So by the time we get to the application stage and we're shopping around, we've got a really good account conduct, we've got our deposit, and we're basically a really attractive customer or proposition for a lender. So they're looking at us and saying, well, hey, yeah, they look like they've got a good character and they're able to pay this mortgage or this loan that we're about to give them, 4 or 5 or up to $600,000 worth of our money, of the lender's money. Yeah. So, but that's the whole idea, is by the time we get to that stage, and then obviously when we're out there and we're shopping, we're able to negotiate with the banks as well, and we're able to negotiate different rates. So what you'll see out there advertised, like these Main Street banks like ASB, TSB, all the ones that advertise on TV. So they're going to advertise what's called a fixed rate, or 1 year or 2 year rates, and that's where we can negotiate those kind of rates and put those in place when we get a mortgage for you.
Gentlemen, because I hear a lot about, the sort of pros and cons of, fixed or floating rates over, fixed term or whatever. Can you talk to us, a bit on, both of those, and maybe what your preference is and your experience dealing with clients?
Sure. Fixed rates makes it pretty easy, I think, certainly for people entering the market for the first time. They'll know exactly for the term, whether it's 1 or 2 years, what they're going to repay on a fortnightly or monthly basis. They can adjust to that quite nicely. Floating, for people that have a little bit more spare cash, could give them a bit more flexibility. They're able to repay their debt a bit quicker without any penalties. But to offset that, there's a slightly higher interest rate associated with it. So quite often, clients have a mix of both, depending on their needs. But quite often for first home buyers, we try and fix them as much as possible so that they can get used to repaying these amounts and having such a big lump sum sitting behind them. It gives them a bit of security. And further down the track, because a mortgage is usually 30 years, so it's quite a long way to go. After a few years, once they might have a pay increase or whatever, we can look at a different structure. So what we set initially is not there for the whole 30 years.
And there's two types of mortgages, isn't there? There's principal and interest.
The standard P&I, yeah.
Which is called P&I, and then there's obviously interest only. So there's two different types of mortgages that people can get, and this is also we're able to mix and match, 50% or 80%. So you could have 80% on P&I and 20% on interest only, or 50. So you can actually structure both types of mortgages in a way that would suit what your goals are in regards to repayment, how much you want to afford every week.
Okay. Can you tell us a bit more about that, either Martin or Andrew? Like what P&I or interest only? What does it mean? Layman's terms.
P&I, principal and interest. So the principal is the amount that you're actually borrowing from the bank. And so you've got to repay that over 30 years. P&I with interest. So effectively 360 terms, same amount for 30 years. Interest only means you're not repaying any principal. You're repaying interest only. Now, the banks will allow you to do that for a maximum of 5 years, because at some point you do have to start repaying the principal. So it can sometimes be beneficial. It's seen a bit more in the investment industry, but even for first home buyers, sometimes having some of it on interest only might be beneficial. Certainly if they're expecting to have a wage rise further down the track, they might be a bit short now and want to repay a bit more later on.
Okay. And Martin, just staying with you, in terms of the most common slip up that you find with clients when they get to this stage that, to avoid.
The most common slip up, that's an interesting one. They try and borrow too much. A lot of people try and borrow too much. I think that they always want to go a little bit further than they like to. And that's where we come in to protect them. So even if the rates are somewhere between 4 and 5%, I use between 7 and 8% for servicing. So I take a far higher figure to make sure that if interest rates did go up in the future, they're still able to repay. And this is where they don't future-proof themselves. They're going, but the rates are only 4.5%. But what if they're 6% in 2 years' time? They'd have a problem. They wouldn't afford it. So trying to borrow too much and not really looking forward to what could happen in the future.
For yourself, Andrew?
Yeah, I think for my own personal experience, and what we're trying to achieve is always communicate and use an advisor and have a good relationship with an organization like us and your registered financial advisor, so that you're always out there and negotiating what the best deals are, and don't just sit and forget, sometimes we just take whatever the bank or someone's given us, and we just wake up 7 years later and go, I could have saved $20,000 if I just called someone and got a better rate, because you always everything's changing, and you're always able to get a better rate, and there's always better ways to structure things, and just don't get just don't give up, and make sure that you're always communicating with your advisor and making sure that you're on top of and understanding exactly what you're paying, how much you're paying back, and what you're trying to achieve. And obviously the first thing we're trying to achieve is get the best rate for you to get into a mortgage, get into home ownership. And then after that, try to stay on top of things and try to keep in touch with your advisor.
Awesome. A very big thank you, Andrew Lovell and Martin Talbot. Thank you so much for your time this morning. And, I'm going to go back over the series and just make my own notes because, yes, at the end of this year, I don't need to divulge that information just yet, but connecting with both of yourselves at some stage in the future. Awesome. Thank you so much, and have a great day and a great week.
Cheers.
Okay. Mate matonga!
That's it, mate
Okay,
matonga.
come on. It is 10 minutes to 8. Coming up after news at 8 o'clock, we have our daily school run. And also coming up after 8 o'clock, before 8:30, I'm going to be talking with a lovely young lady by the name of Olivia Strang, 8 years of age, and she is one of only 7 winners of a global inventors competition. Stay tuned for that. Radio 531 PI, Bring Pacific people together.